And so that's...
Hank, let's go back to the fall of 2008 again, and that very fateful weekend of September 12th to 15th. At that point, really on the Friday, it really wasn't known the extent of AIG's problems, even though they were going to just come cascading in a few days. But you did have this big problem with Lehman, and you called together a group of people on Wall Street, and you thought you had Barclays signed up, and I think they wanted to be signed up, and they ran into problems with the British government subsequently. But it seems to me that on, forgetting about Lehman even, if you had Merrill Lynch that had followed a Lehman bankruptcy, I think you and I would agree that Merrill would have gone almost instantly.
Right.
What would have happened if the BofA hadn't made the deal on Merrill on that Sunday?
Oh, it would have. They wouldn't have lasted, in my judgment. Wouldn't have lasted a week. What people miss, and I think it's easy to miss, was this was a doozy. These excesses had been building up for a long time. I knew we were overdue for a credit crisis, and I told the president that when I came to Washington, but I didn't expect anything of this magnitude. But it had been building up, and it had been building up in the United States and in Europe. And it's, as you can see from reading the papers, it's still working its way through the European system, but it had been building up for a long time. And the institutions have been sitting on losses. We'd been pressing them to recognize losses, raise capital. But so simultaneously, we had, on the same weekend, we learned about the extent of AIG's problems on Saturday. Lehman, the run had already started on Lehman. It was, Merrill was going to be right there. So you had those three institutions. And, as Warren said, we had Washington Mutual, shortly thereafter, and Wachovia. And then we had, over the next weeks, we'd had 6 European nations have to step in recognizing institutions. So this was coming at us pretty quickly from all sides.
And it's ironic, but in effect, I think you talked about Ken Lewis having an appetite for deals or something of the sort in there. Yeah. But if in effect he hadn't made this deal, which does not look like necessarily the greatest deal, he offered a 70% premium on the day when probably the next day the stock might have been at zero. But didn't he, in effect, kind of save the system for us?
Well, it was, I tell you, he was a confident, decisive CEO, and there's no doubt that was very much of a stabilizing action.
Do you think we would have gotten to Tuesday on AIG if there hadn't been action on Merrill that day?
Boy, I don't know what would have happened, because I don't think, Warren, I don't think we could have taken one other big institution bail. Do you?
No.
It just, the system, it is, I think the thing that's hard for people to understand is, we had 10 institutions that had, 50 to 60% of the financial assets in this country, and they're so interconnected. I think we would have, in many ways, we were, as bad as this is, and it's terrible, and but when we look at what could have happened, we're pretty fortunate.
And Hank, the British had given you that kind of British-like veiled warning about the situation a couple of days earlier. I forget, it was Alistair or something. But in effect, they blocked the Barclays acquisition of Lehman. Do you think they understood what the consequences were?
I don't know everything they understood, but remember, there was a requirement for a shareholder vote.
Yeah, that was,
and they didn't.
But we overcame a lot of things in this country of requirements.
That's right. And then what we needed was we needed a buyer that could do what J.P. Morgan did with Bear Stearns, which was fill the capital hole and then guarantee the trading book during the shareholder vote, because there was no authority to do this in the U.S. And what I think people have a hard time understanding, because we're the United States of America, and I had a hard time understanding until I started turning over every stone to see what authorities we have, that there was no authority to guarantee liabilities or to put capital into institutions. But in any event, I'm not sure what, but the British were. I had said in the book, I had used some rash language when I was disappointed. But as I said in the book, as I reflected on it, they obviously had their own issues they were looking at, and the regulator, it was for them a very difficult, it must have been a very difficult decision to let one of their banks go ahead and in the middle of a run on Lehman Brothers step in and make that acquisition and be confident that they had the wherewithal to do that.
Hank, Lehman did go down
Yeah.
on that Sunday, and Barclays then bought a limited part
Yeah.
in a much smaller transaction. And I think it was Tuesday or Wednesday that the British authority, or I guess the British authorities, said that if you had an account with Lehman, even they were keeping your securities there, you couldn't take it out. You couldn't. I mean, they froze the accounts basically, which
Yeah.
I gather came as a big surprise to you. It certainly came as a big surprise to me.
That was, I think, that shocked the market. So it was. My recollection is it was Tuesday, but I could be wrong. But because I recall learning about it Tuesday, and that was actually the day that of the AIG rescue. But what happened was the collateral, third-party customer and collateral accounts, and the broken dealer and others were frozen for a while, and investors needed to know that their accounts were safe. And of course, when they weren't with Lehman Brothers in the UK, then there was a big erosion of confidence in the investment banking model, the viability of the investment banking model.
Yeah, that wouldn't have happened in the United States. I mean, you would have had access to your securities. And,
Yeah.
And as I remember that it didn't get publicized much, but it was a huge shock. Did they consult?
If they did, it wasn't with me. Now remember, the SEC was the regulator. So the SEC was the regulator for Lehman Brothers, and was the one that had the lead in preparing for the bankruptcy. Because we knew that was going to be a possibility. We hoped to avoid it, and they were the ones that would have been talking to the various authorities during that period of time. But it sure came as a surprise to a lot of investors and a surprise to me.
Hank, you and I own, and we own it entirely, a huge investment banking and trading firm, and it's our only family asset. We can't sell it. And we've got all these talented people, and we're making lots of money. You're head of the compensation committee. What sort of an arrangement do you have with them? Can anybody make 25 or 50 million a year? Or are you going to how are you going to treat these people so that they keep making money for us, and they don't leave and go someplace else?
Well, I would say we have to talk about when it is we're doing this and when it is we're making this decision.
Well, let's say we're doing it today.
Well, today, Warren, and you've got to know that you and I, as I say and as I write in the book, and I would have these conversations with Wendy all the time during benign periods, that I think that the compensation levels on Wall Street, are on a whack. Okay, so I just believe that just in general during benign times, and I think you would too.
Yeah, just myself a few times.
Just as a general in terms of how you, and number one, and number two, today, in light of everything that's going on, and the fact that the taxpayer came in to, and granted that the reason the taxpayer did what was to prevent calamity, but it came in and helped the whole financial system. So not just the big banks and investment banks, but hedge funds, everyone. I think that today restraint is very much in order by the top people, and I think the anger is coming from, hey, if you have losses, you're supposed to bear responsibility for those losses. So the way I've talked about it is, I've talked about and said, I'd like to see this anger channeled, and I'd like to see Congress feel, pressure. And I know they're working on it very hard to get the regulatory reform we need so that you don't need to ever have taxpayers come in and prop up, bail out in their present form a failing financial institution. We need resolution authority so any financial institution, any type of financial institution, if it's going to fail, can be liquidated outside of the bankruptcy process in a way in which it doesn't take the financial system down and the economy down with that. So I would like to see Congress get that done and get the systemic risk regulator that can look at every institution, no matter what the size is and type, and if they see risks that are imprudent, restrain them. So I'd like to see that. Now, in terms of longer term compensation, clearly you need compensation. My view is the same as yours, that it should be in equity for the high paid people, and it should be something that rewards long-term performance. That's the only thing that counts, long-term performance, and aligns the incentives of the individuals with the company and its shareholders.
Are we getting the hook?
Gentlemen, we're done.
Okay. Thank you.
Thank you.